TheoTRADE. This is Don Kaufman. It's February 9th, 2024. Just about 30 minutes to go to the cash close here on this Friday afternoon. The SPOOs, they just keep running to the upside. This marketplace, it's just caught up in what I'm now terming the great tech squeeze of 2024. Let's get right to it here. Of course, on this TheoTRADE weekend update, first and foremost, the SPX literally right now tagging the upper edge of its expected move. But look, for those of you that are not necessarily expected move in the know, I'm going to make you in the know right now. First of all, the expected move is the option marketplace kind of handicapping forward risk. The expected move, of course, from this past week was roughly speaking plus or minus approximately $68 and change. We're on it. And I'm going to show you, when I say that we're on it, I mean we're spot on. All right, literally that line on the screen. I just took it down to an intraday chart. That line on the screen represents expected move. We tagged it, coming off of it just so mildly. The shocking aspect, I think, of this, look at the number of consecutive weeks that we're actually hitting the upper edge of the expected move. I mean, to a T, that's spot on, spot on, spot on, okay? That's 4 consecutive weeks in a row. Look, I have got data on expected move right here on Thinkorswim. I've actually got this data going all the way back, and these are hand-drawn expected moves. In fact, in the daily aggregation, right now I'll actually go back 10 years. Just to make a quick point, I've got data going all the way back, and again, that data goes all the way back, as I said, into 2017, and I have never seen, okay, 4 consecutive, not just hits of upper edge of an expected move, but actually closing in and around. Now, hey, before we get there, it ain't over yet. You know, there's still 27 minutes left inside of the trading day. Maybe we come off over here, but there's just no question, okay, with some of the data that I'm going to show you here in this weekend's update, it's a squeeze. So you're in the, again, what I would have to call the great tech squeeze of 2024. Well, first and foremost, something I was talking about, of course, on Wednesday was Nvidia. And we're actually going to start there a little bit in Nvidia. Nvidia spreading up another $22. I would anticipate the wild nature in Nvidia. Okay, this is going to get dicey. I mean, it already is dicey. Obviously, earlier this week, we saw a significant reversal. It actually did rally back up. Of course, yesterday being Thursday, another significant reversal in here, not nearly, okay, to the magnitude that I think that we're going to see. But the aspect that you really have to start focusing on now inside of NVIDIA, look, you could look at the options volume to your blue in the face. It is clear, it is concise. There are call buyers that are actually driving the product higher. That is not what is on my mind. What is on my mind right now inside of NVIDIA, because I was describing how call buyers, for the last few weeks, I've been describing how call buying is actually driving a huge amount of this rally, okay? Specific to, well, if you could just concentrate all of your firepower, you think about proprietary trading firms and market making firms, add a couple of retail clients in there, you concentrate your firepower into 4 or 5 stocks, you can now move markets. All right, plain and simple. In fact, we're going to look at some of the wild divergences going on in the market and how it's clear and concise. It's all tech. I mean, right now, it is literally, it's all tech. There's even declining market internals over here, sectors that are getting weaker, but we'll come to that. One of the things that's just shocking right now is some of the expected moves. This is next week inside of NVIDIA. So you have a $33 expected move. And I'm going to tell you right now, that just doesn't seem like enough. When I say a $33 expected move, you have this $700 behemoth now that actually is only indicating about $33 of price action. But at the exact same time, what you have to be really cautious of is if we actually go over here and pull up what's called implied volatility, you have an inverted, a significantly inverted implied volatility skew. What that basically, well, implies there's more risk right now to the upside than the downside. People, I'm telling you, okay, to say it's dangerous, look, NVIDIA is the most dangerous stock that the S&P 500 has ever known. And I can't stress that, and I've made that statement enough, but I can't stress it enough. Why is Nvidia the most dangerous stock the S&P 500 has ever known? Because what you're looking at right now is a stock literally spurting, if you will, to the upside. Clearly we can take a look at its market cap, and its market cap is about almost 1.8 trillion. So with a 1.8 trillion dollar market cap, it's neck and neck now, of course, with Amazon. But the point of that is, and yes, you're looking at Amazon, it's about 1.8 trillion. But the point being is, again, that Amazon, and I can't reiterate this enough, Amazon's sitting at like a 25 vol, right? Nvidia, I don't even discount some of the earnings in here, but Nvidia is over a 50 vol. So Nvidia, it might have a $1.8 trillion market cap, okay, but it's functioning at twice the rate of volatility that is Amazon. So if you volatility weighted Nvidia, okay, it's worth basically double the market cap. In terms of daily movement, it's worth like double the market cap of Amazon, which puts it in the category of something like Microsoft, right? If you look at Microsoft, wait a second, it only has a 20 vol. Nvidia, again, is sitting closer to a 55 vol, and that's after the earnings period. So Nvidia, okay, it is the beast. It's the single most important stock. You look at Apple, look at all the major tech stocks. You're blue in the face. They're sitting at about a 20 vol. You want to get crazy? Let's go ahead and look at Meta. All right, Meta. Oh, call me crazy. It's about a 27 vol. Meta's a 27 vol, but when it comes down to it, what's Meta's market capitalization? Okay, about 1.2 trillion. So it still pales in comparison. Okay, there's nothing other than maybe Tesla. Tesla's got some volatility. I'm not going to dispute that, but Tesla has even fallen to like a 42 vol. On what? Well, Tesla's only about a $500 million. Or half a trillion. Excuse me. Okay, I get my B's and T's mixed up in here. Nevertheless, okay, Nvidia, it is at this point the most dangerous stock because all you're seeing right now is order flow being jammed down the throat of this. And again, I cannot stress this enough. You're doing almost 2 million contracts, right? You're doing almost 2 million contracts in Nvidia. The whole marketplace yesterday, okay, did 45 million option contracts. So 45 million option contracts total were traded yesterday in the whole market. That includes SPX and spiders. Yeah, you're doing like over 2 million though today in Nvidia of a $700 product, okay? Tell me you're not influencing the marketplace. Of course, you are the marketplace at that point. And yeah, I spent a long time in this, but I'm just telling you, it's everything. That's why it's the great tech squeeze. And the point, again, to be made over here is that the squeeze is being generated exclusively, okay, by gamma. That is the call buying and the nature of call buying, jamming and forcing the stock to be bought to the upside. And that works, of course, until it doesn't. But it is, again, an extraordinarily dangerous time. All right, moving on from the idea of the squeeze. And again, the squeeze in very large part, hey, look, let's actually just jump around here real quick to expected moves. Take a quick glance over at Nvidia. Nvidia obviously outside the upper edge of its expected move. What other tech stocks are in play right now? You would think Meta, but Meta's actually down in the week. You think Microsoft, there you go, Microsoft, upper edge of the expected move. What do you got in Apple? Basically upper edge of the expected move. Amazon, upper edge of the expected move. What do you got in Google? Huge breach of expected move. And of course, Tesla, maybe halfway to the upper edge of expected move, but it's all about Nvidia this week. All right, moving on from there. Markets, they're completely ignoring some of the bonds right now. And to look at the bonds, I'm actually going to cruise over to the TLT. And I want you to pay very careful attention to this because when I say that the market is actually ignoring bonds, I don't really mean the market. I mean tech. I want to be clear about that. Tech, all right, is ignoring the bond market. The bond market not only sold off this week, but actually breached the lower edge of the expected move, which of course implies what? If you take a look at TNX, TNX is of course the 10-year. The 10-year threatening the 4.2 level. I was talking about this on the Wednesday night video. Keep eyes on this because from my experience, anytime the marketplace is ignoring something, okay, it ignores it until it can ignore it no more. And one of the things when I say that, hey, look, markets are ignoring bonds, the irony is, no, it's not, because we're actually going to look at sectors in just a moment. And those sectors, it's not good out there. It's not good. Now, before I go any further, I wanted to also make a point about, what's really driving it, because everybody's looking like it's the most bullish thing I've ever seen. Tech is the most bullish thing you've ever seen. How many stocks are really into new highs? So let's look at S&P 500, which is at new highs, right? okay, versus stocks at highs. So for that, I'm actually going to cruise over to the scanner. All right, for those of you that do not know this, I spent the better part of 15 years of my career working, building, and teaching a lot about the thinkorswim platform. Now, I use thinkorswim extensively. I also, of course, I use Tasty. Okay? I like Tasty. Tasty is like my primary execution platform, but some of the tech on thinkorswim is pretty cool. So I'm actually going to do a quick scan for you. And the scan I'm actually going to do over here, and I'm going to build it on the fly. You ready? We're not going to scan in all stocks. We're actually going to scan specifically in the S&P 500. Why? Because I said in my bullets over here, it's the S&P 500. How many stocks are in the S&P 500 are driving new highs? Think about that for a second. How many stocks in the S&P 500? Because if you've ever looked in the past and the S&P 500 is driving to new highs, there were tons of stocks in the S&P 500 that were making new highs. How many of the stocks in the S&P 500 are actually anywhere near highs? You ever questioned that? Let's find out. So we're going to scan in the S&P 500. Then I'm going to come over here to add filter. I'm going to cruise over to study. See where it says study? I'm going to drop down to price performance. Under price performance, near highs and lows. Under near highs and lows, I'm actually going to tighten this up a little bit, okay? And this is within 2% of the 252 period. 252 is 252 trading days. 252 trading days is exactly, well, 1 year of trading, right? So trading days, I'm actually going to change that. I'm going to change it to 500, okay? Why? I want to know what's within 2%, okay, of its 2-year high. I think that's fair because that's, well, the S&Ps are at all-time highs. How much other stuff is within 2% of its high? Hit scan, okay? It doesn't have to be a complex scan. There's 97 products. I'm just showing you right now. There's 97 products. So what do you actually have? You basically have 97, okay, out of 500 that are basically within 2% of a 2-year high, which equates to approximately 20%. Oh, it's by the way, 20%, you could actually scan during bearish markets and see that exact same crap. And I can't stress that enough. By the way, I don't even look at the S&P 500. Me personally, I look at the S&P 100. That's all you need to really see. If I actually scan now in the S&P 100, look at the irony. In the S&P 100, it's exactly the same. Out of 100 stocks, okay, 19 of them are within 2%, okay, of the 2-year high. It's a low number. It's a very low number. And if you look at them, what are they? Got a little Adobe, a little Amazon. Ironically, there's not even any Apple in here. American Express, a little Berkshire Hathaway, Costco, Salesforce. Okay, I'm actually surprised to see Home Depot in here. GE, who wants that anymore? Okay, of course, Nvidia, Microsoft. It's what you thought. Visa. Okay, these are all S&P 100, but I wanted to cover that, and I just wanted to shave over that very, very briefly because it's such a critical aspect to understand, right? How significant when people's talking about a bullish market and bearish market. Don's getting frustrated. I'm getting frustrated because, yes, okay, it's wildly bullish in specific tech stocks. Okay, where you feel where money managers almost they're throwing caution to the wind. I don't care what anybody says about the rally over here. It's the most dangerous thing to be involved in, okay, and not be defined risk. You're going to be bullish, you better be defined risk, okay, or you might not make it through this. Market internals, they're not great. I actually want to further this over here. And I'm not trying to be bearish. I'm trying to show you, though, what, okay, and how wicked the great squeeze of 2024 really is, or should I say the great tech squeeze of 2024, that internally speaking, this thing sucks. You can look at the advanced decline line. All-time high. Market internals are just not there. Yeah, advanced decline line, people look. You could look at ticks, all right? I'm actually looking, all right, at what we call a comparative tick. The ticks out there, 276. I mean, stuff like this, it's not great. I've looked at, breadth. I'm not into that stuff, but I just wanted to point out, and I'm really not. I'm not a market technician at all. But from a quantitative perspective, right, market internals are not great. I mean, I can appreciate S&P 100 advanced decline line. How often, again, does the market hit an all-time high? When I looked at this earlier, there are actually 60 stocks trading to the downside. Moreover, sectors, okay? Sectors are actually weakening in a wildly bullish environment. And to display this, when I say sectors are weakening, let's move from the S&Ps, okay? Because we know what's driving it. What's really driving the S&Ps? Tech. So you only have to look at like the Qs. If you look at the Qs on a year-to-date basis, just the Qs on a year-to-date basis, they're up about 8%. You start to look at specific sectors like XLK, up 10%. Right? You look at individual stocks like Nvidia, obviously it's going to be even hotter in here. But I wanted to show you around a little bit, like XLE. All right, this is the energy sector. It's actually down in the year, but on a that's down in the year. But okay, it is where on the week? It's actually fallen on the week. So XLE actually down on the week. We come over to XLF, which are the financials. Okay, financials massively unchanged. Now, they're not necessarily that bad on the year. They're up about 3%. Then we come over here to XLP. Okay, if you're not familiar with XLP, XLP is consumer staples. Now, I've made an entire list. Consumer staples getting absolutely decimated today. Okay, they're actually flat on the year. Auto expected moves. They smashed through the lower edge of the expected move. Next in the docket over here, XLU, which is none other than what? Utilities. They actually breached lower edge of the expected move. This is an absolute crap fest. This is following bonds. The point I'm trying to make over here, these sectors are, in fact, listening to some of the bond markets. Then we come to XLB. Okay, again, if you're not familiar with this, the materials sector flat on the day, but where is it on the week? Okay, well, on the year, it's actually down. On the week, down very mildly, and it just goes from there. Well, I'm going to give you another positive sector over here. Here's healthcare. Healthcare actually breached the upper edge of the expected move. And this one, again, I'll give it to you, all right? But it's up only 3%. It's up only 3%. What else you have over here? We can look at real estate. The only one's really moving it when you start to look at like XLY. By the way, XLY is consumer discretionary. The interesting irony is it's consumer discretionary, but it's all Amazon and Tesla. This one's actually comprised of Amazon and Tesla. It's up now 1% on the year. And I'm laughing about it because it's up 1%. You're like, it's huge. It's huge. But it's up 1% of the year. But it actually hit the upper edge of the expected move. Without going any further, I think we actually proved our point over here where the marketplace, okay, is only a tech squeeze at this point. So this is not an argument about being bullish or bearish. I'm fine with what you can call it whatever you want. Okay, it's the pig market. I don't care. What I do care about, though, is you understand how fragile things really are when you're not paying attention to the bond market. You should. Okay, the notes, you absolutely should. The 10-year is actually cracked significantly lower. I mean, it's getting rocked off that last Fed announcement. You look at the dollar. Okay, the dollar broke out this week, for the most part to the upside. That's fairly disconcerting. Everything in here, I mean, even like volatility is down, okay, but it's complacency that actually is a little bit nerve-wracking. Again, that coupled with the fact that, you're hitting the upper edge of an expected move in 4 consecutive weeks. Again, everything in there, it points to, the great tech squeeze of 2024, but there's disconcerting areas of this. Now, of course, you would look at this and say, well, this market could remain very irrational for a very long time. I would agree with that. I would totally agree with that. Okay. But you have to also understand, if you are contrarian in nature, one of the hardest things to do is obviously take the other side of the marketplace. One of the greatest sayings in the marketplace, obviously the market can remain irrational longer than you can remain solvent. The other one, though, is buy when there's blood in the streets, right? Even when it's your own. Now think about that, because the exact opposite is actually true here. It's sell, okay, when this rally and this squeeze is ultimately going on. And there's blood in the streets right now. It's just the shorts, okay, even when it's your own. With that, last thing I'd like to cover here on every weekend update. Once again, the SPX. And the reason we're actually looking at the SPX here is we cracked the so important 5,000 level, okay? We hit the upper edge of the expected move, pulled back very mildly off it. But look, people, it is shocking. You have a $5,000 product that just adheres, okay, to the option marketplace. And I can't stress this enough. When we look at the SPX, this is not settled yet. The SPX, a week out from now, is expecting about a $66 move. Now, there's a CPI report coming out on Tuesday, okay? There's constant Fed speak. This still seems, okay, almost, if you will, inappropriately high. Markets are rallying right now, but the expected moves, they're not really backing off. Again, this last week that we just passed through, we had a $68 move, okay? And I told you guys on Wednesday, get ready for movement. and its movement we've seen. A little bit of a pullback in here, but look, people, we tagged every ounce of $68. So when I look at this next week and I say, oh, it's $66 expected move, for the most part, the same kind of activity, okay, is being anticipated for the next week of trade. So well, sit back and try to relax, because there's nothing relaxing about this marketplace. All it's going to take, people, as I said, the most dangerous stock in the S&P 500. It's all about Nvidia. It's complete and utter fever pitch. You're going to want to watch that trade this next week, because the next week of trade, and you know what, no matter how many times I've done these videos, I always talk about the SPX expected move. I'm going to leave you with this thought. Nvidia today has moved $24. Okay. It's pretty much at highs right now. It's moved $24, almost $25. All of next week, they're only pricing in a $33 move. Okay. I beg to differ. I think you're going to see significantly more movement. Look, this next week of trade, hands and feet inside of the vehicle. Things are going to get a little bit turbulent, and I think it's going to start with Nvidia. Thanks everybody for joining us here at TheoTRADE. Have a wonderful Super Bowl weekend. Bye-bye.